Hello, everyone. My name is Colin Eaton, and this is my end-of-term project. The goal for my project was to take S&P 500 stock market values and create a model and build a prediction for 2023. So my project overview, my goal was to take key financial indicators used in the stock market and historical pricing data for the S&P 500 and to build a model that can accurately predict the stock market and its prices. And ultimately, my question was, when will 2023 hit its lowest point for the S&P 500, or basically predict when the market will be at its bottom using this information and historical data. So the data and the way to analyze it for this type of a problem is using time series analysis and forecasting. So a little roadmap of my project is first step I took was to research key independent variables, basically look at what factors best determine what the price of the S&P 500 will be and clues within the market. After researching these variables that would be needed for my model, the next step was to go out and collect them and find different websites where I could access this historical information for the S&P 500 price and for the independent variables that would be used to predict it. After collecting this data, a big part of my roadmap was to be able to clean this data so that all the different key independent variables would fit together in a clean way to be able to create a model. Once all this data was gathered and cleaned, I ran exploratory data analysis to be able to see how these independent variables reacted with S&P 500 values in general, how they changed over time from the beginning of my data set to the end, and key points in time for these independent variables. After doing this exploratory data analysis, the goal was to build out a couple models. So the first one was a Bayesian multivariate time series analysis, or essentially time series analysis using conditional probability and multiple variables to predict the stock market price, as well as an ARIMA model. After creating these models, I tested and trained different versions, dropping independent variables and changing certain parameters of the models. And finally, to finalize a model that would be used to predict the S&P 500 and its lowest week in 2023. So an overview of my data set. The data set that I have ranged from January 1st of 1990 to the end of 2022, December 31st. In the far left, we have my index, which was the date column, and this date range was jumping by week. So the first value was the second week of 1990 in January, and then it jumps to the 14th, the 21st, and jumps week by week, so on like that. My dependent variable is the next value in this data set, which is the S&P 500 price. And as we can see, it started out really low in 1990, followed by the volume of trades for the S&P 500 in that given week. And this is where the independent variables start. The next independent variable was the volatility index closing value. So the volatility index essentially says how volatile the market is from week to week, or how much change occurs. And after taking the volume and the volatility index, the next one was the Federal Reserve interest rate, the Fed funds. And this is the interest rate at which the Federal Reserve lends out money to banks, and essentially how much the cost of money is. So after the Federal Reserve interest rates, we have consumer sentiment key indicators to help predict as well. So the first one is the number of financial professionals polled in that given week who are bullish on the stock market or optimistic, basically, the percentage of neutral, and then the percent of bears or the pessimistic financial professionals who are polled that week. After looking at those, we have the moving average for this consumer sentiment and the bull to bear spread, or the difference between the number of optimistic and pessimistic financial professionals. So using these independent variables in a given combination, the goal is to predict the S&P 500 price. So the first step in my exploratory data analysis was to run a correlation matrix to see how the independent variables reacted with the dependent variable and with each other as well. So the darker the blue, the more positively correlated, the darker the brown, the more negatively correlated, and the lighter the color, the more neutral, or less effect or correlation, I guess, that the variable has on another variable. So we can see a couple key variables here. The trade volume has a decently high correlation with the S&P 500 price at 0.59. So the more trades in a given week, the S&P 500 tends to go up more. And then we have the negative 0.49 for the Federal Reserve interest rate. So as interest rates increase, the price for the S&P 500 tends to decrease. And then we have some lightly negatively correlated variables for the consumer sentiment. So the bullish is about negative 0.14. And bull to bear spread is very similar as well. So the next step was plotting out the S&P 500 historical prices. And as we can see in 1990, the values were pretty low and steady and increased over time to about 2000. And right around that time was the dot-com bubble crash. A lot of excitement over the internet and prices essentially getting inflated for certain companies. And then it takes a small drop steadily towards 2004 and just goes steadily back up again to 2008 when we have another deep dive in price. And that comes from, as we know, the housing market crash. And then it steadily recovered over time up until 2020, where there was another drop for the pandemic with a sharp increase. So as we can see, after about 2012, prices go up and stay up. Even after a little bit of a crash from the pandemic, prices rebound pretty quick. So here's a few of the independent variables plotted along with the dependent variable of the stock market price. So we have volume over time. As we can see, as the price of S&P steadily increases, so does the trade volume, and volume goes pretty crazy after the housing market crash in 2008, and then again a lot of trade volume during the pandemic of 2020. And the bottom yellow graph is the volatility index, and it follows a pretty similar path to the top two graphs, where the housing market crash, there's a lot of volatility in the market, as well as during the pandemic. Another key variable to plot out over time was the Federal Reserve interest rate. So at the beginning of the data set, it's over 8%, and it declines and grows a little bit over a little bit until the housing market crash, where essentially the Federal Reserve was trying to infuse money into the market and making it very easy for banks to borrow money from them. And essentially the cost to borrow money was virtually free or 0%. It increased a little bit from 2016 and then dropped again during the pandemic when more money was infused into the economy. And then it's shot up as of late up to over 4% again. This graph here is consumer sentiment. So the green represents the number of or percentage of bulls or positive, optimistic financial professionals and how they view the market. And the red is the negative, black is the neutral. So right at the dot-com bubble crash, there's a lot of positive sentiment. Right after the housing market crash, there was a lot of negative sentiment with the red up at the top. And if we look to the very far right, we see that there's a lot of negative sentiment again, as a lot of people believe that we're either headed towards a recession or the Federal Reserve is trying to take us to a soft letdown in the market. So for time series forecast equation, we have a few variables here. The first one on the left is the predicted dependent variable value at a given point in time. So the S&P 500 price in this case that we're going to predict. The X value is a matrix of independent variables, and it's variables for multivariate or one variable for independent or for a univariate model, meaning just one independent variable. The capital B is a coefficient matrix, which is essentially the independent variable and its covariance with the dependent variable over the variance of the dependent variable, or basically how each independent variable moves with the dependent variable over time. And for this in a given point in time. And finally, the E term at the far right is just an error term for just standard error that you see with each given point in time. So the first model was a univariate Bayesian time series analysis, where we took the dependent variable, the S&P 500 price to predict, and the independent variable for this was the Federal Reserve interest rate. And so just using the interest rate and previous values of the S&P 500, we predict a future value one step ahead. So the parameters for this model, as we can see in the code at the bottom, we've got the family, which is the type of distribution for the model, which is normal or essentially positive, normally distributed integer values. Forecast start and end period, which are the beginning of the data set and the end of the data set. K is the number of periods we look ahead in the model. And the prior length is the number of periods that we look behind in the model, predict that number of periods ahead. In this case, K was 1, so we're predicting 1 period ahead using the previous 9 values from the model. We also have a couple other variables. So we have this rho value, which is the random effect extension, or basically the forecasted variance. And as rho increases, we could see more variance in the prediction or a wider range of values that the model could predict. We have the next two are the discount factor for the trend component, or how much to take previous trends into account, and the regression component at the bottom as well. So the results of the first model, as we can see from the graph, we've got that light blue line is the forecast. The dark blue dots are the actual values. For the most part, the model followed along with the prices. It jumps outside of the dark blue dots in 2000 a little bit. When we had that dot-com bubble crash, the model expected prices to go a little bit higher than they did. And then we have a little bit of variance in 2008 as well, as we can see that line going outside the actual price values again, where we had the housing market bubble where the model thought it was going to go higher again, and then a little bit lower when it crashed. And towards the end of the model, it predicts a little bit higher prices than actually occurred, as the line jumps out a little bit again. And the second model used was a multivariate Bayesian time series analysis again, but this time, instead of just the Federal Reserve rate, we added the trade volume, the volatility index, and the bull-to-bear spread. So one more thing added to this model was the number of seasonal periods at the top, or a seasonality component to this prediction, which essentially tells the model that trends can be seasonal as well over a period of 12 months. And here are the results of the second model, which largely followed the first model, but had a few more jumps here and there. We once again have this graph on the right, which is the forecasted values with the dark blue prices as the dots. One other key difference is in 2008, it looks like the model didn't quite predict the housing market to drop as much as it did. And then model number 3 was an ARIMA model, or an auto-regressive integrated moving average. So the first part of this is the auto-regression, or essentially taking previous stock market values to predict future stock market values. The I, the integration, is the trend component that the Bayesian also had. And then the MA at the end is the moving average, or taking a given time range for values of the S&P 500. So again, we have different components that we use to help predict, and a change to this model, we had the random effect being a little bit higher, allowing the model to predict a little bit wider range of values. And so largely this model was able to follow along with the actual price as well, where the price is in orange and the forecast is blue, which is mostly covered by the orange, meaning that it followed along with the model for the most part. And finally, to answer the ultimate question that we had at the beginning, was how is 2023 going to look? When is it going to hit the bottom of the market? And how will the model forecast this to happen? And one thing to note here is that taking a model which is forecasting and making forecasts based on that model, the further away you get from your data set into the future, the harder it is to predict the values, as more variance can occur. So ideally, you'd want to only predict a few weeks ahead, but for the sake of wanting to look at 2023 and get a full-on prediction to see the bottom of the market, or at least when the model would predict it. And it looks like from the model, it predicted that the lowest point in 2023 would be the week of April 16th, when it would approach a value about 3,700. And here are the references for my project that were used to help create the code, as well as research the variables needed and the models. That was my presentation. Thanks for listening.